money this year, and if some funds have shut down new investments, then the only people that are left to fund them are the insiders. So it feels like that is on the uptick. Also, anecdotally, it feels like there's harsher provisions being placed on companies, and I'll go into a few of those a little bit later. It also seems like it takes more time to get these deals done. Diligence takes longer. So obviously if you think about a company that has a factory or something, it's kind of hard to do an in-person inspection of a factory, for example. Another conversation that we've been seeing at a number of board meetings are for companies that have raised a round of venture financing and have got a Silicon Valley debt line or other venture debt line that hasn't been drawn upon. A lot of boards are telling companies, please draw down on the entire facility so the money is in the bank, because a lot of these facilities have outs for the bank if the company is not doing well, et cetera. And the final thought is there's been a lot of attention on the potential for what we call down round financings or dilutive financings. So last year, there were a lot of financings done at high valuations, just a lot of activity. And now for these companies, public market comps have decreased and the companies need to go back to the market to raise. The picture for these companies may not be as great. So, we probably expect the number of kind of difficult financings to increase in the coming months. So with that said, a quick recap on kind of what alternatives companies have got. So for most companies, kind of the universe of financing alternatives are, you've got PPP loans. I think you've got still until June 30th to go apply, and media reports indicate that there's still $100 billion of loan availability out there. For early stage companies, we're still seeing a lot of safes and convertible notes in seed rounds. For larger seed rounds, we're still seeing preferred stock rounds happening, and obviously for later venture-backed companies. We are seeing some companies, that are well-funded going out and negotiating bank and venture debt facilities. So even though most of the banks, like Silicon Valley Bank, were deluged a couple months ago with PPP loan applications, I think they've dug themselves out of that, and most of them are open for business again for normal venture lending. And then finally, it's worth mentioning that there's still crowdfunding projects. So for example, pre-sales of products, et cetera, as a viable alternative to some sort of equity or convertible financing. As I mentioned earlier, I think that there's a lot of challenging terms being tossed about, and it's a little bit too early for me to have hard data on what these things are. But as I do a virtual walk around the halls of my office, we're hearing about valuation decreases, like, term sheets are being renegotiated back in late March and early April. We've seen investments turned into tranche deals. So for example, some amount of money comes in at a first closing, and then another amount of money comes into a second closing after milestones are, have been hit. Similarly, we've seen some staggered sign and close in order for certain milestones or other kind of things to happen before a financing closes. We've seen examples of companies doing more troubled financings where preferred stock term sheets have turned into debt term sheets. And the reason for doing debt is that debt is senior to the equity, and it's also possible to make a debtor secured, so ahead of other creditors. So we've seen some examples of that. we've seen some examples of liquidation preferences increase. So for example, an investor puts in $1 million. If a company goes bankrupt or gets sold, the investor wants $1 million back. So instead of a 1x liquidation preference, we've seen requests for 1.5x, 2x, 3x, 5x. Of course, I'm not sure if that's necessarily related to COVID, but we certainly have deals out there where they're kind of insider bridges to a sale where there's a lot of risk, and a multiple X liquidation preference is certainly warranted for that risk. We've seen requests for what we call full ratchet anti-dilution adjustments. So basically, if there's a bid-ask difference between a company and a fund or an investor on what the valuation should be, a full ratchet anti-dilution is basically price protection for the investor. So if the company does a down round in the future, the investor in the current round gets the benefit of the later down round price. We've seen more beefed up reps and warranties. I think it's certainly because some funds, when they're reporting to their limited partners, want to make sure that they can say, like, look, we're still doing deals, we've taken a hard look, and want to report back that they've crossed the T's and dotted the I's. We've also seen some investors just kind of withdraw term sheets. So some funds have just said, I'm sorry, we can't be investing in the current environment. With regard to deals that are getting done that are kind of problematic and difficult, one thing that we may see in kind of these down rounds, so kind of the hypothetical situation is a company has already raised preferred stock financing, and they're raising another round of financing, but the valuation's lower, or the new investor or the existing investors that are going to fund the company basically kind of want a better deal. And one feature of a lot of these kind of difficult down round financings is some sort of recapitalization. The two elements that might be involved in a recap are a elimination of earlier investor liquidation preference. They may also result in a lot of dilution to the existing kind of cap table. Other things that come up in these financings are the down rounds may trigger anti-dilution adjustments, meaning that the old investors get a little bit more stock as a result of an anti-dilution adjustment from the down round. Oftentimes we've got difficult conversations with existing investors who threaten to veto these rounds unless the terms aren't as punitive to the existing investors. And then finally, we need to think harder about what happens to the management team. So a lot of times in these difficult financings, existing stock options might be diluted, the common stock might end up being worthless. So we think about putting in place what's called management carve-out plans, or employee retention plans, where employees or the management team may get some percentage of proceeds in an M&A deal in order to make sure that they've got incentive to stick through these tough times, especially if they believe that their common stock is worthless. So there's a lot of kind of difficult issues that come up, and some of these conversations are frankly, unpleasant between existing investors and new investors, or existing investors and the other insiders that want to continue to fund a company. So one issue that comes up is, how do you get existing investors to participate in a financing? So basically, you've got what I think of as an economic free rider problem. So if there are a number of investors in a company, if the company gets funded and lives to see another day, well, why should some particular investor take the risk on if other investors are willing to bear the risk. And that really irritates the investors that are participating in the financing. So one technique that's been developed over time in order to incentivize existing investors to participate in the financing is something called a pay-to-play. And generally, the concept is that if you don't participate in a financing, typically to your pro rata or some a dollar amount or amount commensurate with your existing holding, then something bad happens to the existing investor. What that typically might mean is that the existing investor who doesn't participate in the financing might get converted to common stock and lose their liquidation preference and other preferred stock rights. What that might mean in other contexts are the people that participate in the financing, get a benefit. So the deal terms may be particularly attractive for the people that participate in the financing. Let's say there's multiple X returns on a sale of company. But in addition to that, perhaps if you participate in the financing, you get to exchange your existing stock for better stock that's higher up on the liquidation preference stack, or that basically gives somebody that invests in a financing just a better deal. Some of these pay-to-plays get implemented, early on, like even before a difficult financing occurs. However, as a practical matter, I think that most of these pay-to-play provisions come into place when we start having these difficult conversations around the board table and the investors, and the investor that is willing to lead an insider financing says, this is a problem if no one else invests. If you don't invest, then the economics for you need to get worse. So a lot of times we implement these type of pay-to-play kind of penalty provisions in connection with the financing. However, the problem with these pay-to-plays is that it's certainly an opportunity for the investors that don't participate in a financing to sue later. So as a practical matter, if a company does a very dilutive financing, rejiggers the cap table, and the existing investors are diluted and lose all their liquidation preferences, company is probably in trouble. There's probably no real need for an investor that's been kind of whacked in that situation to sue, although they certainly may threaten to sue. The time where they'll actually sue is if the company turns around, sells itself for a high amount or goes public or something. And at that time, the investor that's been whacked will argue that, absent this really dilutive financing, I would have owned X% of the company, or I would have gotten a greater percentage of the sale proceeds. And that's when the lawsuit happens. So the problem is, in a lot of these financings, there just aren't a whole lot of alternatives. So we have difficult conversations with the investors and the board on how to minimize the litigation risk involved. So kind of at a high level, Delaware courts give a lot of deference to board of directors. So there's something called the business judgment rule. So if directors act with due care and in good faith and they don't have any conflicts, then the courts will defer to the decisions of the board. However, in dilutive financings, we often have insider directors, so investors that are represented on the board that are conflicted because they are implementing kind of very aggressive terms that may hurt other investors. So they're conflicted. What ends up happening is that you've got a threat of a lawsuit from the investors that don't participate against the board for a breach of fiduciary duty in the decision to approve kind of the difficult financing. So when you don't have independent board members, or you don't get kind of an independent stockholder vote, you end up in kind of a different legal status if you're in litigation. And basically what that means kind of from a technical legal view is that you end up in something called the entire fairness standard, which means that if you get sued and you've got a whole bunch of conflicts and you don't have the benefit of the business judgment deference, then the board's got the burden of proof to kind of say that the deal was fair from both a process perspective and a substantive perspective, and the burden of proof is on the board as opposed to the deference being to the board judgment on the business judgment rule. So, because of that, these conversations are very, very difficult at the board and investor level. So what we try to do is do things to make the record better. So Delaware courts generally are very skeptical of a lot of things. So things that we try to do are, if there's independent directors available, then we would have a transaction approved by the disinterested directors and maybe set up an independent committee in order to negotiate the financing. However, as a practical matter, in most venture-backed startups, the only people on the board are VCs that may be participating in a deal, and then the management team. The VCs that participate are conflicted, and the management team, like the founder CEO, may also be conflicted because in connection with the dilutive financing, they might be getting an option top-up or a management carve-out. So there isn't anyone who's truly independent to bless the transaction. So the other thing that we look for is the transaction approved by disinterested stockholders. So if basically investors that don't participate that are getting whacked agree to be whacked, that is certainly some protection from the suit of other people. Other suggestions to solve litigation risk are to offer the opportunity to participate to all investors. Sometimes we might even suggest in very dilutive financings, offer the opportunity to participate in the financing to common stockholders, option holders. However, courts are a little bit skeptical as to whether this is really, helpful, certainly because if I'm a random employee of a company, I don't have a whole lot of money to invest in order to protect, my stake in the company. Also, there are securities laws compliance issues with making offers to a bunch of stockholders. In any event, when we have these difficult financings, we're really focused on the process here. Did the board, is there a board record that shows that they've discussed all of the potential alternatives? Is this really the best alternative available? Were there advisors involved, like investment bankers? I think that in at least one of the Delaware cases, there's a comment from in the opinion about, well, geez, if the company was using advisors for marketing on their name change, why didn't they have investment bankers involved trying to help them figure out whether this is the best deal possible? Keeping a good record of board deliberations is very, very important if the company gets sued in the future. So anyway, those are some issues that we grapple with when companies do very difficult financings. So with that, let me turn it back over to the Plug and Play team, and I guess Mark Steiner will get introduced.
Thanks, Yoakum. That was super insightful, and I'm sure many people will have follow-up questions during the Q&A. But very excited to bring on Mark now for a more in-depth discussion. So for those of you who don't know Mark is our amazing general counsel here at Plug and Play. He has over 10 years of experience in venture capital, and Mark directs all of our due diligence processes at Plug and Play for our investments, and also takes care of our portfolio from investment to exit event. So really excited to have you on here, Mark, and I'll let you take it away.
Great. Thanks so much, Christy. And thanks everybody for joining, and thanks Joachim for being here. Joachim's one of the best attorneys in the Valley, and a great mentor to me, and it's great to chat with him. So Joachim, you're a tennis player, so I thought we'd do a little gentle rally here of some questions and discussion points back and forth. So I first wanted to ask, because you touched on it in your talk, how to incentivize and motivate your team, whether your team is 10 people or your team is 50 people, or maybe even if your team is 5 people, in a tougher climate like this. So motivating your team to stay on, whether there be a down round or maybe you're still in the convertibles, but you're having to raise at a lower cap or things like that. So wanted to get your thoughts on 2 things. One is that what you kind of see in terms of strategies. You mentioned management carve-outs. What about pool increases, or what about, decreasing or adjusting your 409A valuation to help better price stock options? Just other strategies to keep your team whole, because you lose the team and you lose a lot of momentum as you're trying to get out of this and slingshot back into a better place as things go along.
Sure. So one thing that's come up for a number of companies is, in order to grant options, the options need to be granted at fair market value. So companies get what's called 409A valuations from third parties to set the option exercise price. We've had a number of companies come to us and say, well, geez, the rosy metrics that we had on sales, are going to decrease because of COVID-19. Should we go back and get a new 409A valuation in order to reprice? We've had a number of those conversations, but I don't think as a practical matter that many companies have gone out of their way to get a new 409A valuation to grant options at a lower price. Part of this is that 409A valuations are generally good for a year or until there's a material event. And some companies are just concerned about the signaling that a lower 409A might give. So, employees talk to each other. If your exercise price for employees from last fall was $1 a share, and all of a sudden the new employee gets options at 75 cents a share, that creates a lot of internal kind of dissonance as to, is the sky falling? Is the company okay? The value of my stock is decreasing. So some companies have affirmatively, decided, even if they get a lower 409A, that doesn't prevent them from continuing to grant options like at a price higher than fair market value, so as to not kind of disturb employees. So that's kind of one thing that we've seen happening, but there still hasn't been a mad rush to reprice options because valuations have decreased. On your second thought about, if you end up doing, a difficult financing and people are going, well, geez, you wiped out the value of the common stock, or you've done some sort of very dilutive thing. So, an employee that might have been owning 1% of the company now owns 0.1% of the company because they've been diluted by 90%. We start having hard conversations about, like I said, management carve-out plans. As I mentioned before, those might be things like, if you sell the company, there's a 10% or 15% pool set aside for the employees, and then there are various variations on it as to whether you've got to be there at the time the company's sold in order to get it or not. So those are all responses to kind of employee uncertainty.
And I wanted to ask, as a separate topic, thanks so much for that answer, for bridges, because I'm seeing a lot of bridges right now, and I'm curious about your experience, and maybe around the Great Recession as well as now, in terms of bridges with valuation caps, because valuation caps are a newer thing. Whether you think most bridges, or you're seeing most bridges, have valuation caps or not, and what the thought process is for founders and investors there.
Sure. So, a couple of thoughts on these bridges. So typically they're going to get, if we're talking about a bridge for like a difficult company, a company where it's unclear where the equity is really going to be valuable, most investors want to do them as debt. And the reason why is to make sure that, like, if something bad happens, the new money is at the top of the stack in case there's a bankruptcy or in case the company gets sold. So we're seeing, most of these as, debt. And, even though the debt can convert into preferred stock, let's say on another financing, I think you've got to think about whether the debt is or what the purpose of the bridge is. Is the bridge like a bridge to another financing? And then, it does make sense that like valuation cap comes into play, or is this really a bridge to a sale of the company? And if so, the valuation cap is like really kind of irrelevant.
Immaterial.
All you're looking at is, do I get a 1x return, a 1.5x return, like a 3x return if the company gets sold? So like I think in the companies that, one of the reasons for doing notes, aside from the notes being secured, is the documentation is a lot easier. While it might take like 4 weeks minimum to get a preferred stock financing done, you could probably get a debt financing done in a week or so. And if it's existing investors, oftentimes there's not a whole lot of due diligence happening. So.
Yeah, and to your point, I think that this time probably brings more urgency to our startups to crystallize. Are they moving towards a new round, or are they moving towards an exit, even if the exit isn't quite what they originally imagined? Because, like you said, that definitely will materially change both the startup's journey, but also their financing options and the terms they can expect. Yeah,
no, absolutely.
So wanted to ask. Just as kind of a quick question here for our startups that are raising on convertibles, just to kind of go over a little bit. I think many of our startups are used to, you might raise multiple times on convertibles, meaning you might raise on a $4 million valuation cap, and then you might raise on an $8 million valuation cap, maybe even a third. I see increasingly more and more raised on convertibles at higher and higher caps before priced round. And just wanted to get your thoughts on, for the startups at those stages who need some more runway or want to raise some more money right now, but the investors are saying, well, we're more conservative, even angel investors. Well, I'm really only looking for a deal that I'm super excited about right now. What about lower valuation caps? Is it simply just another shadow series? Are there other considerations that founders should think about on that?
Sure. So I think that we've seen, a number of examples of companies that come out of incubators. They raise, I don't know, $500K, $1 million on, convertible instruments. At least in Silicon Valley, it's typically a safe, because that's kind of what has become most popular. And you end up seeing safes at various valuation caps. So, maybe, 9 months ago, a company was getting a $10 million valuation cap, but now, maybe their business model is severely affected by COVID, but the team is still strong and the idea is still strong. And it's really what the market will bear. So there's certainly, companies that are, doing lower valuation caps. And then the issues just becomes, does it make sense to go back to the earlier people and give them the benefit of the lower cap, just kind of because it's the right thing to do, or it seems kind of fair? I think the answer is, if a lot of companies are, early stage companies are kind of doing like these rolling closes, like, they get 250K in January, and then they get another 150K in February. And, oh, wow, we've got this, 400K check that's coming in March, but like, they don't like the terms, they want like better terms. If these financings occurring, generally close in time, then while a company doesn't have a legal obligation to do it most of the time, companies will go back and just do the right thing and give everyone the benefit of a lower price cap or a lower valuation in those type of deals.
Great, excellent. Wanted to ask, there are different financing options that you talked about in one of your earlier slides, and this is in a way more of an investment banker question, but in terms of different financing strategies that you can try to, as a founder, especially if you're just closed your series, or not just closed your Series A, but you're post Series A, or maybe you're pre-Series A, you've raised those multiple convertibles. How would you, if you were a founder and you were giving them advice in terms of pursuing other financing options before doing a down round? How would you kind of advise them? Would you say, hey, go to avoid equity crowdfunding because it's such a mess, or that is an option, or insider rounds are fine, or how do you advise your startups?
I guess in order to optimize for getting a financing closed, if a company has already got investors, and investors that are significantly kind of deep pocketed enough, one would hope that they would, and if a company really does need money, probably an insider round is the quickest, easiest thing, because the insiders probably don't need to do that much due diligence. They've got an incentive to make sure that the company doesn't fail. So that's probably the fastest, easiest, quickest route to getting a financing done. Of course, there are plenty of companies that are out there fundraising. Everyone is doing kind of video due diligence, calls, meetings, etc. So, I mean, financings can get done like over Zoom, over video calls. So that's probably not as much of an issue as like just kind of a general, geez, if I'm a VC and in March I saw my 401k plan, nosedive by 30% or something like that, and I'm not feeling good about asking my limited partners to do capital calls, like those folks probably put the brakes on deals in March, and I think we've seen a lot of that. At a macro level, kind of, markets have been up and down and recovered, so people might be feeling better about themselves. It's really hard. Like I said, insider deals are probably the easiest to get done. Going to new investors, like, probably slightly more friction. Because you're not doing in-person meetings. But then of the other alternatives out there, like, I'm really scratching my head. There's not a whole lot you can do. It's like, you got until June 30th to apply for a PPP loan, but like, that's not a whole lot of money. And when you do the cost benefit analysis on it, like, do you really want to be potentially hauled in front of Congress or the media, light on you because you took government money? I'm not sure that makes sense. If you're able to do some sort of pre-sale of product on Kickstarter, like if you're a hardware company, COVID probably doesn't change things a whole lot. Of course, if you're a hardware company, you probably have supply chain issues. So,
what about equity crowdfunding? That's not an option that I would necessarily, push startups to, immediately, but it is a growing area where, both accredited and non-accredited equity, crowdfunding platforms where they'll put a bunch of, smaller investors into a single purpose vehicle, one entity, to try to make things a little bit more manageable. But what's your take on that as an alternative option?
Yeah, so there are some equity crowdfunding platforms that I consider closed systems. So you can only participate if you're already part of the ecosystem. I'm thinking like Funders Club or certain angel list funds. Then there are open kind of equity crowdfunding, things like WeFunder or Seed Invest, et cetera, where you get kind of like this email, hey, are you interested in investing in this type of company? As a practical matter, it seems like for a company, you got to do what you got to do in order to survive. So like, I get that. It strikes me that companies that do broad-based equity crowdfunding, that kind of shout from the rooftops, hoping to get a couple $100,000 in, those companies are probably harder to get financed in the first place and don't correlate well to, getting VC investment, in the future. And not that we're all optimizing to get venture funding, but I think there's probably a strong correlation between getting venture funding and success versus, getting a 250K like broad-based equity crowdfunding down, and success. But once again, you got to be pragmatic about what your alternatives are. I think somebody, I remember back during the dot-com bust, somebody had joked to me to say something like, halitosis, bad breath is better than no breath at all. So I kind of tend to tell that anecdote.
That's a good
over
one.
and over again.
So quick. I think one more quick question, Joachim, before we kind of just open up to the audience. You have a big practice in terms of Japan, and you work with a lot of Japanese companies, major corporations, startups, everybody. And I think you lead the practice there. So wanted to ask about internationally in terms of if you're seeing. There's different markets, so it's a big open-ended question. There's different financing terms and there's different financing structures, but at the end of the day, there's still, mostly equity financing and sometimes convertibles. But anything that you've noticed in terms of the trends that you've talked on so far today, differences in with international startups or international investors?
Sure. No, I think I'm working on, 3 financings that have corporate venture funds as kind of lead investors. And just anecdotally, some of those companies are doing fine, notwithstanding COVID. When I think about corporate investors, I typically think of them in Asia, Korea, Japan in particular. And for some of the companies, like certainly, the internal control CFO person is kind of cutting spending in a whole bunch of different ways. Like, those type of companies may have their deals like reevaluated or put on hold. So, like I said, it's hard to generalize, but I still see, corporate venture deals still happening, although for some companies, just an internal edict to cut expenses or freeze expenses has caused some deals to go on hold.
Well, thanks so much, Joachim. So Christy, kind of leave it up to you for Q&A here.
Sure, thanks so much to the both of you. Everyone in the audience, I encourage you to type out your questions in the Q&A box, but we do have a few already. I think this is a very common one. This is a question to the both of you, how long would you envision the impacts of COVID-19 to last? Given that it doesn't look good to shop around on the market for a long time, should a startup wait until early 2021 to start raising a price round, even if they have to raise a bridge round because their runway is only 3 to 6 months?
Let's see. So the question is timing of financing. So, I think that the general conventional wisdom is that if money is available to you, take it. Most founders probably don't kick themselves for, the dilution that they take at raising money at a lower valuation than they could have. They're more concerned about being, alive. I think that for most companies, like fundraising is a distraction and kind of a full-time job. So if you're going to do, fundraising correctly, it's at least for the CEO, it's got to be a full-time endeavor. And whether to fundraise now or fundraise later really depends on the amount of runway available. My personal suspicion is that a lot of the Silicon Valley investors, one litmus test will be like what happens in September. And the reason why I say that is like just kind of thinking around, like all of these investors have got kids that are going back to school. And if, schools in Silicon Valley are continue to be disrupted and whatnot, that'll probably get into investors' heads like, this is still, a problem. I hate to say it, but I suspect that restarting schools will result in potentially outbreaks here and there, and it doesn't really require a whole lot for one anecdotal story to kind of come out. I just don't know. I think that investors are going to be wary, but in talking to folks, they're looking at opportunities that they've got like available in certain areas. So, kind of the like things that help you work from home or enable communications are great areas to be in. Like online education is a great area to be in. But there's certainly other areas that are hard. So there's not a good answer other than depending on the fact pattern, I would be very, very opportunistic about trying to raise.
Yeah, I would just add, agree with everything Joachim said. I would just add kind of the last point there, like to Joachim's story, bad breath is better than no breath. So, I mean, founders, I don't think should be concerned about a down round if it's necessary, or a flat round, or raising at a lower valuation cap, or, pursuing other options that, maybe a little outside the box, but may work. I would say that if I was looking at two macro trends that I kind of have my eye on, one is capital calls in terms of, and protecting existing portfolio. So as Joachim talked about, VC funds, if there aren't a lot of new investments, then a lot of firms will protect their own portfolio first if they can't call as much capital. So I'm interested to see how the deal volume will continue to look like, because you'll hear from a lot of investors who say, hey, and this is for Plug and Play too, in the Great Recession, some of our best investments were made during that time. So it really leans out the startups, it leans out the valuation. So it actually in some ways makes it a very, very good market for investors. It can be a tough fundraising environment for startups, but can be very beneficial for investors. So I'll be interested to see those capital calls and protecting existing portfolio. But the other thing, this is a bit macro for everything, but everybody's kind of wondering what is a great place to put money in right now. And so I wonder if LPs will still want, I would think in a way that they would still want to put money, especially into technology investment. I mean, where else is a much better place to put money into right now in the markets? So on the one hand, I think we can all recognize it's a tough period, but there are also some reasons for optimism for startups in the Valley, as well as startups throughout the world. Because I think also in regards to our corporate partners, digitalization, this is only accelerating it in many respects. And so that has very direct things like how Zoom's market cap has risen, but I think there's indirect ways that technology is going to be accelerated. So I think that might not help Main Street as much, but I do think it will help startups.
Sure, and that's kind of in line with our next question. We often talk about the companies that are struggling and not doing so well, but what is your advice on financing for companies whose growth has actually been accelerated by COVID-19, like the companies in the supply chain industry or kind of the verticals that are doing really well out of this pandemic?
Sure. So I've got a company that is actually, very, very benefited from COVID, or at least a couple of them. And they weren't planning on raising financing, but kind of given the market opportunity, both like if they had more money, they would be able to spend it in order to grow faster. So they've got like a very unique point in time where having more cash would be helpful, especially from a marketing perspective or a sales growth perspective. Those companies are very opportunistically, out there trying to raise as much money as possible at the best valuation that they can get. So I think that we've seen a number of examples of those type of companies like, hey, we already have like a year and a half, 2 years runway, but would be really nice to put another 200 million, 300 million in the bank just so we have it for a rainy day and we can spend and grow faster. Maybe it's for the Super Bowl ad or something.
I would completely agree. Just an anecdotal story, which in the midst of the pandemic, one of our portfolio companies, Applyboard, became our newest unicorn and raised a wonderful round. And I think that's an interesting story because that term sheet was signed pre-COVID, and Applyboard is I'm going to oversimplify this to be quick, but they're a marketplace for international students and North American universities to help students and universities kind of meet the optimization of the best students for the best price, and so that's heavily impacted because our international students going to be admitted into the U.S. in the fall. We don't know that. So short-term, a major impact on the company. So the VC firm that led the round, to Joachim's point about slowing down due diligence, they said, well, we want to look at this a little bit longer and we want to think on this longer. But really what they fundamentally came down to was, is the thesis of Apply Board still applicable? And absolutely, and maybe even more so, down the road. So ultimately, they did close the financing round, and I think that while I think that it's very dependent on, is this a long-term horizon, or is this the idea is that the startup will exit in 1 or 2 years, because a long-term horizon is not as impacted, I think, as the next year or two. So that's one point I'd mention.
Thanks, Mark. So I'm going to switch gears a little. I know that there's been a lot of talks these past few months on PPP loans. And Mark, you sent out a great email to our portfolio companies kind of explaining all of that, because it's quite confusing. And I'm sure, Joachim, you've answered plenty of questions around PPP loans as well. But we have a question from a startup. So if you're a startup that qualified and received PPP funding, can you go to a different bank to get additional PPP? We already cleared the requirements for 100% forgiveness. We have heard recently that you can go back for additional funding through PPP since there is still money available.
So that's an interesting question, but I would have thought that for a company that applied for a PPP loan a couple months ago, they would have applied for the maximum amount available to them. So it's unclear to me, like what additional amount that they would try to go get. But once again, I have not focused on the PPP rules for a couple months now. There was a kind of a wave where my entire day was 14 different phone or video calls, like kind of explaining, geez, are you affiliated with your investor? Like, hey, do you really want Elizabeth Warren asking you questions in front of Congress, in 6 months? Sorry, not Elizabeth Warren, but somebody like Elizabeth Warren asking you questions in front of Congress. The number of questions that we get on PPP recently have really more focused on kind of very technical issues as to like, when do you apply for forgiveness? One thing that kind of happens one kind of common question is that a lot of companies are doing M&A deals now, and a company that's got an outstanding PPP loan that's getting sold to another company, generally a sale is an event of default under the PPP loan. So we need the PPP loan like repaid before closing. Of course, the seller is kind of going, well, geez, I wanted that loan forgiven, not kind of repaid. That mucks around with my numbers. So that's kind of a common issue that's come up a few times in the last kind of week or so for me.
I would just add to the question, it might be, maybe there's some confusion. As Joachim said, if you requested the maximum amount based on your payroll and also rent and a few other expenses, then you can't necessarily double dip. So the money did run out on the initial PPP program, and then that was enhanced. And that was so more money was issued to the program, to the Small Business Administration, to issue more of these loans. So there might be some confusion there in the sense of just because they've increased the pool and there is perhaps still some money left, doesn't mean you get to take out 2 loans. If you took out the maximum amount, that was really your one bite at the apple, to my knowledge. The other thing I would say is that now that we're coming around to forgiveness, I would just emphasize all of our portfolio companies and non-portfolio companies that to do a careful analysis of necessity, because to what Joachim's saying is that the purpose of these loans was to save jobs, and loan forgiveness in particular was to save jobs, and in particular really help mom and pop small businesses, help people who really have no alternative ways to finance. So if, as a startup, for example, you obtained a PPP loan, you thought that the world was coming down on you and this is your last best measure, and that's still the case, then that's a very different story than if you received a PPP loan and that got you extra months of runway, and great. And in that runway, you were able to raise more financing, 500K on a safe, or you were able to raise multiple millions on a priced round. That's when you should really be considering paying back the loan rather than seeking loan forgiveness as a matter of necessity. So.
Mark, that's a good point. So one conversation that we've had recently is, should we apply for forgiveness or not, or should we just kind of repay the loan? So some of the companies that got to the conclusion that it would be prudent for them to get the PPP loan in the first place are now kind of going, well, geez, that gave me a couple months of runway. That's helpful. I'm going to raise a round of financing. Should I repay the loan, or should I still ask for forgiveness? I think that there was guidance that was put out a while back that basically said that if the loan is less than $2 million, the government is not going to spend any time investigating for fraud, absent kind of some egregious facts. So the likelihood that there's real kind of criminal civil liability and penalties for improperly taking a loan is low. There's still the media kind of issue. So some of the higher profile companies like LA Lakers, Shake Shack, it was my recollection, were kind of publicly shamed for taking the money and immediately repaid them. So I think that for a number of Silicon Valley companies that took loans, if you raise a round of financing, it probably makes sense to repay the loan as opposed to look into forgiveness on it. But anyway, that's just my thought there.
Yeah, I would. What I would also add is that, I think for it's either 2 or 2.5 million for every loan less than that there will be no automatic audit. There will be an automatic audit for anything larger than that. So I think that if a startup's taken on a loan and it's greater than 2 or 2.5 million, I'd say that's probably a company that's in a priced round, post-priced round stage. That I think is a very different calculation. Potentially depends on a lot of variables, but for startups that are before that, and as Joachim mentioned, those PPP loans that are less than 2 million might even be for a couple 100,000. Those on the one hand don't give you 2 years of runway, but I also think that they demonstrate, depending on your circumstances, might very much have something that kept you afloat, kept your team of 5, 10, 15 afloat, and you're continuing to work your best to raise money right now to keep the company going. I think that that's a very different calculation of loan forgiveness. So if you're above the 2 or 2.5 million threshold, I really think that's something that you should take into account versus whether you're below it. Not simply like, oh, well, we're not automatically gonna get audited, so forget it. I'm at 1.8, it's fine. No, I mean, there's a lot of criterion and factors involved, but I do think that in terms of the PR that Joachim's talking about, if one day your startup, which right now has only raised 500K and got a $50,000 or $75,000 PPP loan, if then a year from now or 2 years from now you've been struggling, and then you raise a big round and then you end up being the world's greatest startup, 10 years from now, I don't think there will be that PR backlash that back when you were 5 people, you took a $50,000 PPP loan and that kept that kept the 5 people of your team there. I think if anything, that might be a bit of a success story, even though tech, I don't think, is the main street that the PPP program is really meant for. So I think it really matters on the necessity question as well, in terms of the PR down the road too.
Perfect. Well, we have 2 minutes left, and I don't know if we can get this question finished in 2 minutes, but kind of on the topic of federal programs. Any thoughts on the new Main Street federal program? It requires around 65K in 2019 adjusted EBITDA, which is hard for a startup, but we've heard there will be allowances for minority and women-owned startups. Any advice on how to approach this new program?
So, from my practice, a couple of companies that were later stage that weren't able to qualify for PPP or just didn't make sense for them, started looking into Main Street lending and came to the very quick conclusion, given EBITDA requirements, like Silicon Valley, it just no one's going to be able to qualify.
Right.
So at that point, I stopped reading the rules myself personally. We've got a team of experts that have been reading them, but I personally decided, this is not applicable to any of my companies, so I'm not going to be bothered to learn anything, about this other than you don't qualify is my stock answer.
Yeah, I would just quickly add exactly like the concept of venture capital is we're financing your growth, right? And so that means you're by almost definition not running cash flow positive. So Main Street not. Now the interesting thing in the question though was allowances for minority or women-owned enterprises, and that's a really interesting point. I don't know the answer to that. I hadn't seen anything on that, but I certainly think it would be great if different government programs took approaches like that. But I just haven't personally read on it, but I'll look into it.
Thanks, Mark. Well, I think we're all out of time, right at the 11 o'clock mark. I know Joachim has to run, so thank you so much to the both of you. For all of the people in the audience today, we'll follow up with a survey to ask about how PPPs and kind of general government funding programs have impacted you. But otherwise, thank you so much for joining us, and we hope to do another one soon. So thanks, Mark and Joachim again, and hope to see you again.
Okay, take care. Thank you very much, guys.
Thanks, everyone.